Investing isn't just about numbers, it's about emotions. Fear, excitement, impatience, and panic can push even smart investors into bad decisions that sabotage long-term results. The truth is, you don't need to predict markets to build wealth. You just need to control your reactions to them. When you learn how to emotion-proof your investments, you stop making impulsive moves, ignore market noise, and stay focused on long-term growth. We'll break down simple, practical strategies that protect your money from the biggest threat in investing: your own emotions. Today, we'll talk about how to emotion-proof your investments. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Why emotions are the silent killer of wealth? Most investors lose money not because they choose the wrong stocks, funds, or strategies, but because they allow emotions to dictate their decisions. Fear, greed, panic, impatience, overconfidence, and even boredom can push people to buy at the wrong time, sell at the worst moment, or jump into trends they don't understand. These emotional reactions often lead to impulsive decisions that break long-term plans and destroy returns. Emotion-proofing your investments isn't about ignoring emotions entirely. It's about building systems and habits that prevent them from controlling your financial choices. 2. Understanding your emotional triggers. Emotion-proofing begins with understanding what triggers your reactions in the first place. For some, it's seeing their portfolio drop, even by a small percentage. For others, it's hearing exciting news about a new stock, cryptocurrency, or trend that everyone is getting rich on. Your emotional triggers could be tied to social pressure, past experiences, financial insecurity, or unrealistic expectations. Identifying these sources helps you predict when you're most vulnerable to emotional decision-making and gives you a chance to pause before acting. 3. The fear of missing out, FOMO. FOMO is one of the biggest emotional traps for investors. When you see a stock skyrocketing or social media posts about people doubling their money, your brain assumes you're missing an opportunity. This leads to buying high, often right before the price corrects. FOMO-driven decisions create unnecessary risks, push you into speculative territory, and distract you from your long-term strategy. To emotion-proof your portfolio, you must accept that the market will always have hot opportunities, but long-term wealth rarely comes from chasing them. 4. The panic selling reflex during market drops. When markets crash or even dip slightly, your brain interprets the loss as danger. Panic selling is the body's natural response to fear, but in investing, it guarantees locking in losses. Historically, markets have always recovered after downturns, sometimes even stronger than before. Emotion-proof investing means training yourself to stay calm during drops and remembering that volatility is normal. The goal is not to eliminate fear, but to prevent fear from forcing you out of long-term positions prematurely. 5. Overconfidence and excessive risk-taking. The opposite of fear is overconfidence, another dangerous emotion. After a few profitable investments, many beginners start believing they're naturally skilled. This leads to bigger risks, larger trades, and ignoring proper diversification. Overconfidence can wipe out years of gains in a single bad move. To emotion-proof your investments, you must constantly remind yourself that the market rewards discipline, not ego. Even the world's best investors make mistakes. Thinking you're different is a quick path to disaster. 6. Creating a written investment plan. A written investment plan is one of the strongest tools for emotion-proofing your decisions. This plan outlines your goals, timeline, risk tolerance, asset allocation, and rules for buying and selling. When emotions rise, whether it's fear during a crash or excitement during a bull run, you can return to your plan and follow it mechanically. This prevents emotional impulses from becoming financial disasters. A written plan acts as a contract with your future self. You commit to logic even when your feelings protest. 7. Automating your investments to remove emotional interference. Automation is one of the simplest ways to remove emotion from investing. By setting up automatic contributions into index funds, retirement accounts, or long-term portfolios, you eliminate the need to make frequent decisions. This reduces the temptation to time the market and helps you buy consistently regardless of price. Automating doesn't just save time. It protects you from emotional reactions by making investing a routine rather than a conscious decision. 8. Using diversification as emotional insurance. Diversification reduces the emotional stress that comes with investing. When your money is spread across multiple assets, stocks, bonds, real estate funds, index funds, international markets, etc., you're less likely to panic when one piece drops. A well-diversified portfolio gives you stability and confidence, which lowers emotional pressure and helps you stay calm during volatility. Emotion-proof investing relies on structure, and diversification is a cornerstone of that structure. 9. Setting predefined rules for buying and selling. Define your rules before you invest, not during emotional moments. For example, I will only sell if the company's fundamentals change. I will not buy a stock because of hype, only after research. I will rebalance once a year. I will not react to daily price movements. These rules act as guardrails, preventing emotional decisions from derailing your strategy. When the market tests your patience, your rules hold you steady. 10. Limiting market exposure to reduce emotional noise. Constantly checking your portfolio exposes you to unnecessary emotional highs and lows. The more you watch daily market movements, the more likely you are to react impulsively. Emotion-proof investors reduce exposure by checking their portfolios periodically, monthly, quarterly, or even yearly. This shift allows you to see long-term trends instead of temporary fluctuations. Less screen time equals fewer emotional triggers, less stress, and better long-term performance. 11. Practicing the 10-year mindset. Adopting a 10-year mindset means evaluating investments based on their potential over a decade, not a day or week. This mindset reframes volatility as background noise and shifts your focus to long-term growth. When you think in years instead of minutes, emotional reactions lose their power. Every dip becomes a buying opportunity, not a threat. Every hype-driven spike becomes a distraction, not a signal. The long-term mindset is one of the strongest shields against emotional decision-making. 12. Separating your emergency fund from investments. One major cause of emotional panic is putting money you may need soon into risky investments. If your investment money is tied to rent, bills, or emergencies, fear will always control you. To emotion-proof your portfolio, you must separate short-term needs from long-term investments. An emergency fund, usually 3 to 6 months of expenses, gives you the psychological safety to ride out market fluctuations without panic or fear. 13. Understanding loss aversion psychology. Loss aversion is a psychological principle that states humans feel losses twice as strongly as gains. This means losing $500 feels worse than gaining $500 feels good. Knowing this helps you prepare mentally. When the market drops, your brain exaggerates the loss. Recognizing this pattern allows you to pause, question your feelings, and remind yourself that the fear is temporary, but the gains from staying invested are long-term. 14. Learning from historical market behavior. Emotion-proof investing becomes easier when you understand history. Markets have crashed, corrected, stagnated, and exploded dozens of times over the last century. Yet over the long term, they've always trended upward. When you study past crashes and recoveries, you realize that panic is a normal part of the cycle, not a signal to exit. History teaches humility and patience, two critical traits for controlling emotions. 15. Building a support system or accountability structure. Investing alone can magnify emotional decisions. Having a knowledgeable friend, coach, advisor, or community provides accountability. Discussing decisions out loud forces you to justify them logically rather than emotionally. Even writing in a journal or analyzing your decisions after the fact helps you notice emotional patterns. Support systems reinforce discipline and reduce irrational impulses. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.